Thank you so much for tuning in, and a special welcome as always to our CFCS members and certified professionals. For those of you who are joining us for the first time or are unfamiliar with ACFCS, we are a professional association that exists to serve the community of financial crime prevention and detection specialists by sharing information across sectors to promote the continuous learning needed to keep up with this ever-changing environment of financial crime and prevention, which is why we have this fantastic panel here today to help share that knowledge and expertise and really give us the tools of the trade to help us keep trucking along. My name is Cheyenne Visca. I'm the training manager here at ACFCS, and I'll be the host for today's session, Custodian Crackdown, an analysis of regulators' actions against custodians, FCMs, and broker-dealers. And again, we have a phenomenal panel here today. We're so excited to have you all join us. We have Elizabeth Callan, who is the AML and FinCrime Risk Management and Compliance SME at SymphonyAI Sensa-NetReveal. Elizabeth brings with her a wealth of knowledge, more than 20 years of experience in AML in both public and private sectors. She's worked for the U.S. government in both intelligence and law enforcement, including the U.S. Treasury, as well as within financial institutions for consulting and technology, and continues to advance AML and financial crime compliance and risk management. Elizabeth, thank you so much for being here. We are also joined today by Robert Mara, who is the partner and principal at Ernst & Young, where he continues to co-lead the financial service risk technology area for the Americas. Robert brings with him experience in the financial industry, software, telecommunications, and education. He also works in evaluating and mitigating the impact of new technologies and products in the compliance space. We are also joined today by John McKessie, who is the managing director of BlackRock's Financial Crime Group with the Legal and Compliance Department. John is responsible for the global AML and sanctions compliance programs and works closely with the regional financial crimes team throughout the firm. John has previously worked for Citi and MasterCard in a variety of compliance and financial crime investigations, dealing with card product sanctions and oversight of global AML programs. So a ton of experience here today. A phenomenal panel. I'm so excited to hear from you. But before I hand it off for all of the interesting things, as always, a couple housekeeping slides for you here. If you run into any audio or visual issues, if at first you don't succeed, please go ahead and refresh your browser. If that still does not work for you, please go close out of the additional browsers and all of the tabs that you may have open in any and all of those, and see if that helps. If that still does not work for you, go ahead and close out and rejoin the session. We do recommend Chrome or Firefox for the online browser, as they tend to work best. If you are using a VPN, you're still having troubles, try disconnecting and rejoining. And, again, there's always closed captioning here for those of you who are interested in it. There is a certificate of completion. You'll see that in the bottom right-hand corner that will be available for download at the end of the session and available in the ACFCS online platform following the completion of the session. This session is recorded, and those slides will be available within three business days. So keep a lookout. Keep a lookout for the recording. The slides are currently available for download in the right-hand side. You'll see them under the resources section if you want to follow along. We do have a post-webinar survey underneath the media player. We do love to hear your thoughts, your feedback. We really try to do better. We want to know what you're interested in. We do read those, and we will pass along the feedback. We also have a Q&A box in the right-hand side of the screen. Please let us know comments, thoughts, questions. We will be looking out for those, and we do have time budgeted at the end to answer any questions. And then just to keep you on your toes this morning, we're going to start out with a poll. Just let us know where you're from, what sector you're working in, or what type of entity do you work for? Is it a large diversified financial institution? Are you a smaller financial institution? Is it a pure broker-dealer? Pure futures, commissions, merchant, custodian, asset manager or wealth manager, or other? And then if you want to test out that Q&A box as well, we would love to hear where you're from. Are you in the States? What state are you in? What country are you in? We had over 62 countries. We had people from over 62 countries register for the event, so we're excited to hear where you're from. And with that, while we're waiting for those answers to trickle in for that poll, Elizabeth, I am going to go ahead and pass it over to you just so that we can get started and launch into this topic of, oh my goodness, and look at all those trickling in, so many. So what has been happening? We're talking about custodians, but what really has been happening with respect to regulatory development in this space?
Thanks, Diane. So I think where I'd like to start with the story is I think a lot of the, at least building and current attention on custodians really might track back to generally the segmentation across the different types of firms that operate within the securities industry, but in particular, investment advisors. So, you know, there's a little timeline here. It obviously doesn't cover every single thing that's been happening in all these different areas with respect to custodians, broker-dealers, and FCMs. I mean, it would go on forever. But I think these are some key developments that I'd like to talk about that I think underpin why we're now seeing unprecedented actions against custodians. I think, you know, just to remind everybody, I mean, going back almost 10 years now, it feels like forever ago, but it's been 10 years. In 2014, OFAC had a major settlement with a large European custodian around its custodying of assets for the Central Bank of Iran and the movement of those assets within its custody relationship. And so that was those were direct breaches of sanctions at the time. So going all the way back to 2014, we saw that kind of key step. Right. And since that time, there's been a lot of, I think, communication and narrative momentum. We haven't seen any specific steps regulating investment advisors, but there's been a lot of narrative. There's been some actions against broker dealers, futures commission merchants, and now we see a custodian in April with an enforcement action. But I think really it pertains to sort of the conversation that's coming from the regulators and at a national level around the risk that's inherent in the industry. So in 2015, the US proposed a rule to bring investment advisors under AML regulations. And that may have been tied to the fact that FATF at the time was doing a mutual evaluation review and report, and in 2016 publicized that report, which emphasized the fact that investment advisors, along with designated non-financial businesses and professions, but in this case, we're really focused on investment advisors, they're not regulated in the US, or certain ones aren't regulated in the US. And so that's a, you know, kind of a gaping risk that we have in our financial sector. In 2021, we saw policymakers, or certain policymakers, get into the mix with a proposed bill called the Enablers Act, which was looking at bringing gatekeepers, certain gatekeepers, and the different types of firms and entities that fall within that group under the BSA regulation. It never passed. It hasn't passed. It's still kind of circulating out there. It's still around. But I think the important thing is that you now have policymakers coming out and talking about these types of risks and what they could pose to our financial system. I think probably most interesting in our timeline is in February of 2022, the US released its National Money Laundering Risk Assessment. And they've been doing that. I mean, you know, this isn't the first one, but I thought what was interesting in this particular publication is that they very specifically highlighted the fact that segmentation is an issue. It creates a lack of transparency, and in particular with respect to custodians and the omnibus accounts that are offered in certain types of relationships. So you can see in the bottom certain quotes from that publication that I think are especially poignant, right? The use of third-party custodians, particularly with, you know, when combined with omnibus accounts, obviously can impede transparency. And I think, you know, this all goes to effectiveness. And in particular, the effectiveness question now, you know, given that there's proposed rules out there around, you know, how FinCEN's looking to change the expectations around program effectiveness. You know, some banks might feel like, well, is the regulation there? For custodians, it is certainly. For investment advisors, certain ones, it's not yet. But I think we've heard different FinCEN representatives at different in different fora speak to the fact that, do you necessarily need to wait for specific regulation, or is it a matter of effectiveness and the risk-based approach? So if you know it's a risk, regardless of necessarily regulation, you probably need to still pay attention to it. So I thought this particular quote was especially poignant. In addition, they go into two particular examples, right? Broker-dealers ordered to execute a trade on behalf of a client may not know the identity and risk nature of that client. And likewise, a custodial bank holding assets for a private fund manager, right, may not know the identities of the investors in the fund. So, I think this risk is very similar to other types of long-standing risks that we've seen in the business, right? So for correspondent banking, for example, long-standing, well-known, higher risk business type, traditional correspondent banking, custodians obviously kind of fall into that category. But with traditional correspondent banking, everybody think there's consensus around the fact that it's higher risk. There have even been concerns around de-risking, but it's very similar, right? You have your direct customer, your respondent bank, and then you have downstream customers or counterparties that are really truly the primary source of risk. And there's sort of like that blind spot, that wall that's created because of that segmentation. So custody is no different. And whether it's a matter of transacting in, liquid, cash within a custodian relationship, or it's, different types of assets, securities that are being moved around, it's the risk is really about the moving of value, regardless of what form that value takes. And the custodian is able to do that, but there's that wall in between. And so that kind of brings us to 2023. So I think what's interesting is, we have an unprecedented action by FinCEN against, yes, a smaller company, right? It's not a big financial institution. It was a small trust company in South Dakota, Kingdom Trust. But I think what's interesting about that is Kingdom, while it's a trust company, a big part of its business was custody. And so that penalty came out in April, and I'll talk more about that in a second. But I think the last thing I want to note is that the International Securities Services Association, which is, an association made up of private sector financial institutions in the CSD and custody businesses and a couple of other areas, but they've convened a working group for 2023, and that working group is charged with delivering a revised inherent risks report around the risks within the custody business. They did this back in 2017. They put out an inherent risks report, and then they also put out what they called pillars, for compliance in this area as sort of guidance for, the financial community. So they're looking to do that again, and I think, maybe in some ways this portends that the group is looking at what's happening and thinks that, maybe the community will be well served by additional updated guidance in this area, particularly to prevent, obviously, any kind of enforcement action from happening. So just to quickly look at the Kingdom enforcement action, primarily, like I said, while it's named a trust company and it does perform those services, it also engages in custody services. In particular, the activity of concern here was around the facilitation of $4 billion worth of payments for Latin America-based broker-dealers that had even had difficulty establishing accounts in the U.S. with other entities. So then they ended up at Kingdom, and Kingdom actually moved forward with providing services to them. So the action goes on to note that some of the activity involved a BVI domiciled private fund. So, if we think back around what was pointed out in the 2022 U.S. money laundering risk assessment, of course, it noted not only custody and omnibus accounts, but of course, the issue of private funds. And, we were talking about that this might all track back to the inherent risk of investment advisors. So here you have that kind of situation presenting itself in this enforcement action. And so ultimately, FinCEN found that Kingdom failed to file numerous SARs on hundreds of suspicious transactions. And of course, you've got the segmentation here and the lack of transparency probably having something to do with a lot of that, right? So Kingdom sees the transactions, but does Kingdom have enough knowledge about the downstream owners or counterparties of the transactions associated with those custodied U.S. bonds and cash in this case? Probably not. It's kind of always a struggle. There are other actions. I mean, numerous other actions have taken place with broker dealers and over the years, but I think there's a couple that involve omnibus accounts. We don't have the time to talk about everything and in detail, but a couple that I'll point out just to note. Back in 2018, all three, the SEC, FINRA, and FinCEN, enacted an enforcement action against a U.S.-based Swiss broker-dealer for the failure to prohibit the sale of unregistered securities, again, within that omnibus account. And then in 2016, FINRA fined another a different US-based Swiss broker-dealer for the failure to properly monitor penny stocks and penny stock trades within its omnibus account. So I just think, the moral of the story is, things seem to be gaining momentum. I think the regulators are getting more intelligent about how this looks, right? How this risk looks, what in fact is able to be done within this business from a criminal standpoint, from an illicit activity standpoint. And it really seems like FinCEN is picking up some of those things that were noted in the 2022 National Money Laundering Risk Assessment and taking action against them. So this action was against a custodian, which was noted in the risk assessment. But if you guys saw on Friday, FinCEN also fined a Puerto Rican international banking entity for suspicious activity involving correspondent banking and other things. But I think what's interesting about that is IBEs were also noted as a risk in the 2022 National Money Laundering Risk Assessment. So we might be seeing some sort of pattern here where it seems like FinCEN is picking up things that are in the risk assessment and maybe looking to take action against them. So John and Rob, do you guys have anything to add to that?
I can start off a little bit. I mean, I agree, Liz. I mean, I think that there's certainly a lot more focus on this area than there was historically. And, I think we've seen sporadic pieces popping up over time, but I think what we're seeing is more consistency. And we're seeing it, you're talking primarily about the US regulators, but we're seeing it in the global regulators as well, is a lot more focus on this business area. And what we're also seeing is a lot of times, like here, I mean, we're talking about, a small place in South Dakota, but we're talking about $4 billion in payments. What we're seeing a lot more in this is the regulators starting to notice and realize that, while it may not happen as frequently here as it might happen in sort of traditional banking areas, when it does happen, the volumes end up being fairly significant. And so the risk ends up being fairly large. And then when you start to layer on the sanctions framework on top of that, then you have a whole nother element where even if you're a fairly small organization, you have that risk. And the costs associated with those risks through fines and other types of regulatory actions are significant enough that it's not something that can really be minimized as it often was historically.
John, do you have anything to add?
Yeah, just real quickly, I think one thing to note here, we're the focus of regulators and examiners, and you can see, Liz mentioned the 2016 mutual evaluation by FATF, and I think that has increased in its influence across the global community here. But the one thing to note is, as I'll say, my long history, the focus initially was, I'll say, on high-risk areas such as correspondent banking and private banking going back by 20, 25 years. As those areas, I think, mature in both compliance systems, enforcement actions, and regulatory expectations, that then starts to translate or, look into other areas such as custodians and other areas that may not have had the attention historically, but as I'll say, examiners become a little bit more aware and start to look at the risk in certain areas, I think that's where they pick up those questions and start to have greater expectations. One of the challenges I do see in the industry is typically what ends up happening is that they take lessons learned from other parts of the industry, say banking type approaches, and then say that should be applied in this new area. And sometimes that's just not, it's an apples to oranges type comparison. Yes, they're both fruits, but they don't have the same operational structure. They don't have the same risk, or ultimately how you control for it may be differently designed than what you've had in the banking industry. So I do think that's something we continue to see and will continue to emerge over the next 5 to 10 years.
Yeah, that's definitely like a thought that I hadn't considered before, as I have seen, the responses come from, enforcement actions on other institutions, but absolutely important. And that kind of leads us into our next section here, where Rob, I'm going to throw this at you. What do those risks and challenges look like for these firms going forward?
Yep. So I think that there have been, and John brought up, I think, a very good point that I'd like to reinforce a little bit, is that one of the challenges that the regulators have had historically is, this is a complicated space. It's not something that, I think, and I talk with the people that I work with as well, it's fairly easy for people to understand the idea of, criminal walking into a bank with a sack of cash, or, you see, different types of money movement activities. But understanding the complexity of this space, I think, is something that the regulators have started to come much more rapidly up to speed on. And that's changed the view, because the more that you understand about the space, the more you understand where the risks happen to be. And the way that I look at it is generally that there's multiple risk dimensions, and I'll focus on 3 of sort of the key ones in this area. Is the role, the client themselves, and then of course the products. And Liz had mentioned this a little bit about the transparency aspect, but that's where the role comes into play. Is each firm may have a different role in this overall life cycle of the transaction. I mean, I've seen different trading types of activities, and if you look at the end to end, there might be a dozen or up to 20 different firms involved in these transactions, sometimes even more if it's a fairly large transaction. And the role that somebody might take, and the ability to understand what that particular role is, and what that, your particular visibility into the entirety of the transaction might be fairly limited, which presents you a bit of a problem when you're starting to think about how you're going to monitor for some of these risks. Because, if you're just an executing broker, if you're just the custodian, you don't see everything that's leading up to that point. Sometimes you might have the end-to-end. I mean, a number of the institutions will cover the entire transaction end-to-end, clearing, settlement, custody, transfers, all the different types of pieces. But not every firm does that, and not every firm does that for every particular transaction. So you need to look at, your specific role, and the role that you have, or the set of roles that you have, are going to influence the types of risks that you need to look at. Another piece is the client. A lot of cases, in a lot of these cases, you may not know who the ultimate client is with respect to these transactions. When you start dealing with omnibus accounts, when you deal with funds, you might have if you're a custodian, your client might have a number of clients under them, and it might be, nested clients on top of that. So understanding, what risk your particular client has, and this is, fairly basic in terms of concept, because KYC has been around for a long time, but understanding, specifically with your client, know your client's client. You can keep on adding C's at the end, so it's not just KYC, it's KYCC, KYCCC. There's a lot of different pieces here in terms of understanding where, what clients you have and what roles they're playing with respect to their clients. And then the third piece that I always like to focus on is the product themselves. Products can be, easily tradable. They can be liquid. I mean, we've been hearing about low price security trading and bearer share activity for many years, and those still remain risks even in today's industries. But we're seeing money laundering activity happen in very mainstream equity shares being traded through secondary markets, alternative venues. We're seeing, private transactions, but we're also seeing the different types of products that you have influencing the different types of risks that you might that might occur in these spaces. I mean, we all, I'm sure, read about the mirror trading activity. There's a lot of this activity, and I think one of the things that's really coming out in this space is just the dollar amounts again. And I mentioned this before, the dollar amounts are much, much larger. You're generally not seeing, the penny criminals with, thousands or tens of thousands of dollars. You're seeing millions and billions of dollars transacting through these markets. And given the nature of the products, the clients, and the roles that your firm plays, your ability to look and understand exactly what's happening can be very challenging. And so you really do have to look at risk in a different way than you might have looked at it in the banking side. So I encourage, all of you who operate in this space to really take a look at these different types of dimensions. And this is by no means an exhaustive list of the different types of events that might happen, but it gives you an idea about the flavors that you need to be thinking about when you're thinking about how you're going to be looking at risk in this area. And if we move on a little bit and start to talk about how you're thinking about monitoring in this space, and that was one of the elements that popped up in the Kingdom case, I think what you've seen is historically, most of the monitoring systems that have been built have been focused on really traditional banking, because that's where this all kind of started. When people were looking at this stuff originally, you were looking at it from the original Bank Secrecy Act. You were looking at the the build out of FATF over time. People were looking at very, very straightforward stuff. And you were looking at again, sack of cash coming into the bank and not knowing where exactly that came from. And a lot of those systems were built out with those things in mind. And now certainly those systems have evolved over time to deal with things like correspondent banking, trade finance, and so on. But they really have not been evolved to the point where they can take a look at the sheer complexity that's involved in this area. There's a lot of inferential data analysis that you need to look at. There's a lot of documents that are being brought into the picture. You're looking at communications, possibly through emails, that are going to contribute to this. You have a lot more collusive activity that's happening with the different firms happening in these areas. And that really changes how you have to think about the monitoring in this space. Historically, from what I've seen, if you look, broadly at the securities space, you're typically seeing, whereas the industry as a whole typically averages, 95 to 98% false positives. When you look at this particular space, it's usually 99.99% false positives, because you can look at some of these pieces. And when you look at just the pieces that are being monitored through these existing systems, yeah, you're occasionally going to catch something. But, one of the examples that I always used to like to give was, common scenario in every single anti-money laundering monitoring system in the world is flow through of funds. Well, if you have a DVP or RVP account, that's what they're supposed to do. That's normal behavior. And so you get a lot of junk coming out for those types of things. And when you start to look for something like mirror trading, those systems are not really designed to handle that. And so what you really need to look at doing is either building on top of an analytics platform that allows you to bring in this broader set of capabilities, but also think about migrating the data infrastructure. We've seen a lot of movement towards a big data type of infrastructure, because when you start to look at these areas and you start to look at the dimensions that are involved in the risk here, it's not as simple as it is in a lot of these more contemporary rules-based monitoring systems. You need to do something different. Doesn't mean that there's not still a place for those, but much like you look at trade surveillance, most firms do not have a single trade surveillance platform, because the different nature of the products requires that you're going to be building out different types of surveillance platforms. You're going to have different types of surveillance analytics, depending upon whether it's futures, equities, fixed income, structured products, whatever it happens to be, not to mention alternative investments, which can be messy in and of itself. But when you look at those types of things, you've generally built out different types of surveillance methodologies for those. But then when you look at AML, trying to fit that into a traditional monitoring platform that has historically been focused on, direct money movement, whereas a lot of the money movement in this space happens indirectly. It just doesn't work quite as well. And so I do think that firms need to take a look at this, and we're starting to see a number of firms out there either building their own platforms or in collaboration with some of the software vendors, enhance their platforms to build out specific things in this area. A lot more use of the AI ML space because, again, these things get very creative. I mean, if you look at the mirror trading scheme, that was fairly creative, and it involved multiple jurisdictions. It involved, in some cases, multiple broker dealers and multiple players throughout the course of the life cycle of this activity. That's a little bit more challenging, and the traditional monitoring generally doesn't work quite as well in that space. And I know, Liz, this has been a focus of yours in where you work now. Maybe you could give us a little bit of your thoughts about how you're starting to look at this.
Yeah, thanks, Rob. I guess a couple of things. Rob talked, we've talked a lot about the inherent nature of the way the industry is situated and the way those products and services operate introduces different types of risks or vulnerabilities. I think the other thing to keep in mind here, and this goes back to Rob's point about sheer volume and value in this part of the sector, it's massive, and I think it's very sophisticated. So you're not dealing with low-level money launderers here, executing simple placement layering and those kinds of things. You're dealing with very professional, sophisticated money launderers, criminals. They know the business. Oftentimes they're professionals in this business or had been previously, and now they know all the ins and outs of how to use the business to launder. So that kind of trickles then into how do you calibrate a program? How do you design a monitoring system? How do you design controls that adequately deal with the inherent vulnerabilities of the product or service or the nature of the business, but also how the criminals are operating in this part of financial services. It's obviously not easy, as Rob said. I think the other thing I want to highlight is going back to IAs. Pooled funds are a major piece of this, right? The custodian might be the servicer, the broker dealer might provide some kind of service, but oftentimes it's the funds and the investors in the funds that are the key vulnerability here. And how do you wrap your arms around that, particularly where KYC might be an issue, right? And I think a lot of this then translates into the types of monitoring, right? So obviously big data demands things like machine learning. I mean, I think it's just natural, and analytics. I think in the case of machine learning, what's interesting there is that because of the big data, and because of the fact that, it's really difficult to understand not only how the products and services work, but then what do the typologies look like. It can often help to use, not necessarily only, but, certainly a combination of, traditional rules-based monitoring and SME kind of driven approaches, but also machine learning, be it supervised, unsupervised, semi-supervised. I mean, I think all of those different types can lend themselves here, in particular because they're able to do a good job of revealing patterns. And I think once those patterns are revealed, that's something that humans can digest and say, okay, well, are there typologies that we can derive from this? And then can we use those typologies to feed into sort of refinement of our program and our approach and how we tackle this? So there's lots going on here, but I think the last thing I would emphasize is just, there's a lot of, I think, risks that have been around in AML, and everybody's paid a ton of attention to over all these years. Things like correspondent banking, trade-based money laundering. But there's so much value and activity that goes on in these kinds of businesses. I mean, the custody business, I mean, you could have a big custodian that's got $40 trillion of assets under custody, right? So obviously a lot of that is not at all suspicious, but it's just a big space. It provides a lot of cover for, nefarious activity, and just makes the whole compliance and risk management effort that much more complicated.
And thanks, Liz.
Yeah.
I think the pattern aspect is key to this. It's you're not going to have all the pictures, so how do you look at it? I mean, John, I know, sorry to interrupt. I know you have some thoughts on this as well.
Yeah, I think your point about the big picture is very important. When I think about it again, having now been in the industry, broadly speaking, for a very long time, the one thing I definitely see is, money launderers like to be creative. So they're always looking for a new way of moving money back to them. And so sometimes I do think we all need to kind of take a step back and look at it from sort of a money launderer's point of view, and how exactly is the industry changing in a way that actually may make it an opportunity for a money launderer to be involved. And when I think about sort of in the past 10 years, in the future now 10 years, it's going to be a very digital world. And so there are three things that are happening that are going to transform both the securities, broadly speaking, industry. Does have an impact to the banking industry, but broadly speaking, to securities is blockchain technologies. So again, quicker, faster, more throughput. Rob, you mentioned sort of, and Liz, you mentioned AI. I think AI will have a big impact on the industry in terms of just how they think about trading and how that actually may involve within the operational structure. And then last, I think, I think it's a little not talked about, but I do think sort of the cloud world and the cloud technology is actually going to have a big impact to those two first areas. The leverage that you can gain from the cloud will make all these things much more available to all those smart engineers who are always thinking about ways to kind of move things quicker, faster, more efficient. And that's the end game from a profitability point of view. Except in those cases, again, you kind of leave the door open an inch. Like my dog, they will bust through to say hello to you. So the money launderer is going to bust through in a way and see if they can kind of get their money or their opportunities moved. Because of what we talked about, I mentioned earlier, the enforcement environment around the more traditional methods has really clamped down. It's much harder, not to say impossible, much harder to move bulk cash. It's much harder to do correspondent banking. It's much harder to trade finance. It's become much harder. Again, not impossible, but just the opportunities in those areas have decreased over time. It's become more expensive. So a money launderer is always looking for a new way. They have ransomware, so they got to get payments from different locations than they probably would have had typically before. So it's an evolving world that I think we have to adapt to.
Rob, could I just add one thing to what a good point that John brought up? And this was something that I learned very quickly when I was still back in the government doing investigations on these kinds of actors. One particular difference about securities and securities-centric business in terms of the attractiveness to money launderers is the fact that not only can you launder money, but you have the possibility of making a return on your money. So it's very clear that that's a big distinction between this part of financial services and things like retail banking or credit cards or any of those other areas of financial services. As a launderer, there's like multiple ways that you can leverage this kind of business and multiple different benefits you have at your disposal from laundering money in this sector. And I think that's a really key one.
I know we were speaking on that too, Elizabeth, and it's, definitely a challenge for this sector. And in that same vein, like how can firms and institutions enhance their risk management efforts to really address these? I'm going to pass this to you, John.
Yeah, thanks. So I think sort of kind of using the themes that we talked about today, really focus on three areas. So I think it's on the next slide, if possible there. Yeah, great. So again, when you think about sort of your risk management, your compliance risk management practices, There are various different areas, but for purposes of today, I really focus on 3 overall areas. First and foremost, I always believe the risk assessment is a great opportunity for the compliance officer to take that step back and really evaluate how is your firm evaluating and controlling for those risks. And there are 2 kind of key parts to that risk assessment practice that I think have to come through. The first is you really need to understand your product and risk profile, and it's a qualitative review. You really need to meet with different teams because they all kind of have a different part and stake in the role. So everyone from your ops team to the traders to the sales team, just to understand what's the dynamics happening in the industry, what is the firm thinking about. For example, in the enforcement action with Kingdom, there should have been, I'll say, an earlier recognition that they were looking to expand into different markets, different clients, different opportunities there. But then secondly, you do need to take the quantification, and kind of the evaluation of what the business is doing and compare that to your profile. So if you're not hearing about your Latin American clients, but then you're also seeing an uptick in volumes of activity connected with that region, or a different type of activity based on product groups, that should, again, spark those questions of what am I seeing here? It doesn't happen overnight. I was involved in many very large frauds, and we always had a saying that it doesn't start, no one ever comes to the table and says, I want to commit $1 billion fraud. It always starts with $1 million here and $1 million there, and it just builds up over time. So it's the same thing with money laundering. It doesn't start overnight as a $4 billion money laundering matter, but it starts over time with little trickles, and eventually the floodgates open when they realize what they can do. The second piece of it, and Rob talked about this earlier in terms of transaction monitoring, you really need to start thinking about your typologies. How does your operation work? Who are all the different counterparties and different elements within that chain of your transaction? The securities industry, more broadly speaking, is much more of a fragmented area versus what we see in the traditional banking, at least in some areas. So you really need to understand when I execute a trade, who's touching it. When I receive these assets and I'm custodying them, who are they coming from? What does that represent? And you need to ensure that you're providing that training and resourcing across the team. Again, when looking at transaction monitoring, it always, again, the floodgates open. All of a sudden you get a volume of alerts if you actually have an operating system. And ultimately, you need people to look at it, evaluate it, and respond to it. And again, looking at the missed SARs over time by Kingdom, it's a classic example. The banks have suffered through it. It's where there's something that has happened where they didn't initially detect it, and then later on, when they do a look back or other reviews, they realize they missed all this activity. Hindsight is a little 20/20 in those situations, but I think it's indicative of some level of weakness kind of leading into that. Again, that should be part of your risk assessment. You should be looking at the transaction monitoring, but ultimately for your transaction monitoring approach should be taking into these kind of different parts of that review. Last but certainly not least is about governance and oversight. And, this is where kind of the rubber meets the road in terms of your engagement with business units and other parts of the business. Clients reviews and different investigations. How well do you understand your how transactions occur? Who are the different parties to it? For if you are taking on new clients, how's your KYC methodology incorporated there? Have you evaluated for different product mix or different regions? Who are those counterparties? Rob mentioned there before, sort of the KYCCC and going on. It's very important in this industry to know not just who your your client is, but also who your counterparties is. And I think that's one of probably emerging areas in this world, is where the know your counterparty is becoming synonymous with a KYC, you know your client. And a lot of those, I'll say, counterparty risk management approaches are merging together in terms of a more holistic oversight and due diligence approach. And last, in terms of the governance and oversight, is really thinking about new business and product expansion. What are your controls around that? I say that's easier said than done. So for some business teams, they think of just more sales as not a new business or a product expansion, it's just more of the same. But there's a big difference between marketing or looking to service, to clients that might be in the U.S. and in sort of a lower risk area, to expanding to bring in Latin America broker dealers. That's a big shift in sort of the product or business focus. So that's something, again, you need to think about, how do I get informed about those subtle but important changes in your business? Goes back to, again, risk assessment's always a great opportunity to ask those questions. A lot of times because we know that the regulators will look at the risk assessment and we want to make sure it's done completely, we might force feed it through a process. But I think always it's important to take that step back and think about, am I evaluating the risk? Have I thought about, if I were a money launderer, how would I do it through my organization? And so those are some of the opportunities, I think, when you think about your risk management practices within AML compliance, to really blend in the learnings from these various different enforcements.
Absolutely. And Rob or Liz, do you have anything to add on those points?
I can jump in with a couple of things. I think John touched on, everything. A couple of things that I would emphasize. I know from my days managing an FIU at, coincidentally, a custodian, one of the things that really worked well is training, like particularly for FIU. A lot of times your investigators, it's very hard to have in-depth experience in these areas and be very familiar with how the business works. But it's one of those things where, how are you supposed to find the atypical if you don't know what the typical is? And as Rob mentioned, there's so many things about just purely the nature of the business here that, it's just the way business is done, but it can present vulnerabilities and opportunities for, nefarious activity. So training your FIU investigators in particular on the business, and then also the business on what the risks look like, because sometimes they're in the best position to be able to identify it. Even if it's in a manual way, they're still in the best position to identify it. And I think second, Robin mentioned trade surveillance. A lot of these things are so closely tied together, right? And to look at them in silos, creates another type of wall, right? We talked about the wall of, between segmented firms, but there's also the wall between trade surveillance and AML. And so I would emphasize that, the need to really either integrate them in ways, and I think the industry is looking at those different ways and maybe maturing in that respect. But I think even without that, looking for ways to synthesize whatever it is that your trade surveillance effort is doing with what your AML effort is doing, and creating that, more comprehensive picture of all of the activity, because oftentimes, depending on the typology, that's the only way you're going to find it.
And I'll add one bit to one of the things that we talked about before, as well as John mentioned, and some of the questions that come in about, I'm not expecting that there's going to be a significant change in the regulations themselves in terms of what the expectations are going to be. But what I am expecting is that a lot of the historical practices based upon an interpretation of the regulations may not be quite as prevalent. Like as an example, a lot of things that happen in the security space operate through different types of reliance agreements. I do not, and I know there's been some questions about, clients, client, we mentioned clients, client, and so on, counterparties. the expectation I don't think is going to be that you're going to be doing due diligence on all the parties that are involved in a particular transaction up to the ultimate owner. And that's not, frankly, practical. But what I do expect is that there's going to be a lot more questioning of, does this make sense? I mean, if we go back to the thing that Liz was talking about originally about Kingdom Trust, you're talking about a bank in a custodial bank in South Dakota, and it's getting billions of dollars coming from Latin America. Well, what exactly is that Latin America to South Dakota connection? I'm personally not familiar with it, but are you seeing things that are happening with your clients that may indicate that maybe they're not operating the way that you expected? And so whereas historically, and I've been in the industry for a long time, there was sort of almost a blind reliance agreement. If somebody else said, okay, we're counting on this person to do it, you just trusted them to do it. And I expect that what we're going to be seeing a lot more is, okay, you can trust, but you have to verify, and you have to actually monitor around this to look a little bit differently and to question a little bit, because we've seen any number of anti-money laundering actions happen against the world's largest financial institutions. That's a pretty good indicator that, the ability to rely on them to do their jobs, I don't think you can really do that. And so you need to at least have some method of taking a look at what you're doing and saying, hey, does this make sense? Do we expect to see this volume of activity in this product from this location for this client? Does that make sense based upon what we know about that client? And if it doesn't make sense, then you should be taking a look at it and saying, well, why is this happening? Is this something that we feel comfortable with? John mentioned taking a look at the risk assessment. I'm seeing organizations do, depending upon the client, individual level risk assessments that tie into their broader risk assessment. I'm seeing product risk assessments starting to pop up in a lot of different areas to say, does this make sense? And that's basically what we're saying is, the idea that you don't know all the pieces of an activity does not necessarily preclude the ability to make some assessment of risk based upon the information that you do have. You're never going to have the whole picture, but you're going to have enough pieces of the puzzle. And using some of the newer technology like AI/ML, you have the ability to look and maybe start to uncover patterns that give you at least reasons to ask the question. Doesn't mean that always the question is going to be yes. I mean, as John was mentioning, not everybody out there is a money launderer, and the vast majority of the traffic through this particular space is perfectly legitimate. But that's sort of the money launderer's forte, is hiding among the, hiding the needles among the stack of needles. And that's what they're trying to do.
That was always something that I struggled with in the AML field, is when you're looking at so many things that are suspicious, is trying to remember that you're looking at a very small portion and there's a lot of legitimacy going into it. I did have a brief stint dealing with custodian funds where I was moving from an FI to this company, and the dollar amounts were just overwhelming, that shift and that adjustment. So it's, like so many good points on really understanding what it means to conduct in this space, the differences, what is normal. And I really appreciate you all being here and sharing this insight. For our attendees, please feel free to throw your questions into that Q&A box. We do have about 5 minutes, so we would love to hear from you. It's your last chance to throw those in there so our speakers can get to them. I know you touched on this a little bit. Liz, would you touch on there's a question about the SEC no action letter. Would you be comfortable touching on that?
Related to the no action letter related.
Pardon, let me read the whole thing. Right now, broker-dealers that rely on registered investment advisors to fulfill their obligations under the CIP rule and CDD rule for beneficial ownership requirements for legal entity customers operate pursuant to an SEC no action letter that was originally issued in 2004. And this was recently updated or extended to 2024. In your Do you think that this no action letter will be rescinded?
Rob, do you want to take the first stab at that? I have some thoughts, but.
Yeah, and I kind of mentioned that a little bit. I don't necessarily see that it's going to be rescinded because, I mean, practically speaking, again, I mean, this entire space would come to a crashing halt if you had to look at all the different pieces and all the different players down there. I mean, it's not like a correspondent banking type of transaction where, now you need to actually understand where the funds were originally sourced from. And, when you're going through those, this is something where you're going to have lots of parties. And I don't think the expectation is that you are going to, that the SEC or other financial institutions or financial regulatory authorities are going to require that then you do that next level down of due diligence on all the clients. But again, as I was saying before, I expect that you can't operate in a blind reliance mechanism. So when you have reliance, that's fine. And you can rely on them to connect that information and to collect all that information and do their jobs. But it doesn't mean that you have to completely trust it. You have to have some ability to monitor for this and understand what's happening, because you do have intermediaries, and understanding the role that intermediary plays and what you're seeing with respect to that. Does it make sense to you in terms of what they're doing? And if it's not, then it's your obligation to ask questions. So I think the era of just sort of, well, we have the reliance agreement, and so therefore, historically we haven't had to ask these questions. That portion I think is done, but I do not think it's going to add on a whole nother, at least anytime soon, any other burden of actually going down to that next level and doing KYC on your clients, whether it's for a loan facility, as was asked earlier, or whether it was asked for specifically in this case with the investment advisors. I don't anticipate that happening. I don't know, John or Liz, if you have any thoughts on that as well.
Yeah, I was going to add, Rob, I think it all goes back to, taking a risk-based approach. So I agree with everything Rob said, but I think, there has to be some effort to determine where there might be elevated risk, and does there need to be additional due diligence there? And I think if you go and look at the ISSA docs that I referred to at the beginning, there is some reference to this, and they kind of articulate it in a similar way, right? Think about the risk, think about if that means you have to go down one level or two more levels, right? To be confident that you have a firm understanding of the risk.
Yeah, I would generally agree with that. I think it's the great thing about the compliance field is it's a mix of everything. So you have to do the legal analysis, understand what your obligation is, what the other party's obligation is. You need to apply a little bit of risk management and understand the risk and how do you want to mitigate for that. And then the last piece of it is really, applying the subject matter expertise, really discussing risk appetite within your firm. And trying to think about that. When it comes to some of these areas, depending on the location and the type of product, the legal obligations can shift. So if you have a private fund through Luxembourg, you have certainly far different obligations than you might have as a private fund in Cayman and so on and so forth. I do think FATF has really pushed them to be a more convergence around those obligations, so the standards have continued to rise. But I think when you think about yourself as the securities firm, you need to think about that counterparty and what type of risk is being presented in that relationship. So that's where that risk management, risk appetite really needs to come into play.
And just by the by, because I know there was another question on, I had mentioned IBE earlier, International Banking Entity. Those are those non-federally chartered institutions in Puerto Rico. In that consent order, there actually was a mention of a lending facility. So whoever asked that question, you may be interested in reading about that in more specificity, but they did note that there were some deficiencies around that.
All right, Well, thank you so much. We are at time. Any questions that we didn't get to, we'll be sure to pass along to our speakers so they can touch base with you there. A big thank you to Elizabeth, Robert, and John for joining us today, and also you to the audience for tuning in. And just as a reminder, the slides are available for download in the right-hand section if you'd like to keep those for your reference. The certificate of participation will also be available in the bottom right-hand corner for download, and you'll also find that on the LMS, the ACFCS platform, within 3 business days. The session was recorded, so if you want to go back and reference or rewatch it, or if you had to drop halfway through, please come back. It is available. It's some incredibly valuable information. Jump back on. And with that, I want to thank you all again for being here and keep fighting the good fight.